Somebody just placed an 11,000 contract bet that gold is hitting $20,000 by December. Not $6,000. Not $10,000. $20,000 per ounce. And they didn't buy gold at current prices. They bought the right to profit when it crosses $15,000 and runs all the way to $20,000. This is a deep out-of-the-money call spread. The kind of position you only build when you possess information the rest of the market hasn't processed yet. But here's what should terrify you. While Wall Street is positioning for $20,000 gold, the United States government just did something with silver that has never happened in the entire modern history of this republic. And when you connect these two moves, the gold bet and the silver decision, you will understand exactly what's coming. This isn't speculation. This is pattern recognition. And the pattern has played out 3 times in recorded history. Same sequence, same outcome, every single time. Let me walk you through the mechanics of this trade because the details reveal everything. Gold futures settled around $4,990 this week. Down slightly. Holiday trading. Stronger dollar. Nothing alarming on the surface. But underneath, in the options market, something extraordinary is unfolding. Traders have accumulated December 2026 call spread structured between $15,000 and $20,000. The position has grown to roughly 11,000 contracts. State Street's head of commodities research called them cheap lottery tickets. Think about that phrase for a moment. When one of the largest institutional asset managers on earth describes a trade that way, it signals 2 things. First, the trade is far from current market prices. Second, the people building this position are not retail speculators throwing away rent money. These are professionals who understand probability, who calculate risk-reward ratios for a living, and they are doing it anyway because the potential payoff justifies every dollar of premium paid. For this trade to expire in the money, gold would need to triple from current levels by December, from roughly $5,000 to $15,000. That sounds impossible, except gold already hit $5,600 last month. It already proved it can move $1,000 in a matter of weeks. The question is not whether gold can make violent moves. It just demonstrated that capacity. The question is how large the next move becomes. And to answer that question, you need to understand the cycle. The cycle that has destroyed every empire that entered it. Mathematical certainty, not opinion. The Roman Empire debased its currency to fund endless wars and administrative bloat. They reduced the silver content in the denarius from 95% to less than 5% over 2 centuries. Soldiers were paid in worthless coins. Borders collapsed. The empire fragmented. Verified. The Dutch Empire in the 17th century fought ruinous wars against England and France while maintaining a global trading empire. They borrowed heavily. Interest payments consumed state revenues. When confidence broke, capital fled to harder assets. The guilder collapsed. Their dominance ended. Check. The British Empire after World War I held the world's reserve currency. But war debt was catastrophic. They tried to return to the gold standard at pre-war parity. It failed. They abandoned gold in 1931. Sterling lost reserve status. The empire dissolved within a generation. Verified. 3 empires. 3 currencies. Same pattern. Same sequence. Same outcome. Debase the currency. Lose the confidence of your creditors. Watch capital flee to hard assets. Collapse. Now let me show you where the United States sits in that exact same cycle. U.S. national debt is $38.43 trillion. It is growing at $8 billion per day. Not per month. Per day. Interest payments on that debt are about to cross $1 trillion annually. The Congressional Budget Office confirms that interest expense is now the fastest growing line item in the federal budget. Faster than Social Security. Faster than Medicare. Faster than defense spending. You cannot tax your way out of $38 trillion. You cannot cut your way out. The math does not work. There is only one path left. Inflate the debt away. Debase the currency. Print until the nominal size of the economy grows large enough to make the debt manageable as a percentage of GDP. And that path, that exact policy, is now confirmed. Kevin Warsh, the newly nominated Federal Reserve Chair, confirmed over the weekend that the Fed will coordinate with the U.S. Treasury to implement yield curve control. Let that sentence land. Yield curve control. That means the Federal Reserve will artificially suppress interest rates on government bonds to keep borrowing costs manageable regardless of what the market wants. The last time the United States ran yield curve control was during and after World War II. It is the monetary equivalent of admitting the debt is unmanageable at market rates. You are telling bondholders that they will earn negative real returns for years. You are telling savers that their dollars will lose purchasing power by design. And you are telling anyone paying attention that the only rational response is to move wealth into assets the government cannot print. The Trump administration began the year with Elon Musk attempting to cut federal spending through the Department of Government Efficiency. That effort failed. You cannot cut $38 trillion through efficiency audits. So they pivoted to the only option that remains: inflate, suppress rates, and pray the nominal economy expands faster than the debt compounds. If that is the playbook, and every piece of evidence confirms it is, then gold is not going down long term. It is going up, way up, because yield curve control is the most bullish possible environment for gold. You are guaranteeing negative real interest rates. You are guaranteeing that inflation will run above the yield on government bonds. And you are guaranteeing that the central bank will buy whatever quantity of bonds is necessary to keep yields pinned down. The $20,000 call spread makes perfect sense in that world. It makes sense in a world where $38 trillion becomes $50 trillion becomes $60 trillion, and nobody even pretends the debt will ever be repaid. Morgan Stanley's chief economist published a note saying nothing will change materially under Chairman Warsh, especially in the near term. The Fed is a committee. One person does not rewrite institutional policy overnight. But even Warsh, despite his hawkish reputation, is stepping into a situation where the debt is so colossal and the interest payments so crushing that the only realistic option is financial repression. Inflate, suppress, print. That is the path. And gold is the hedge. So when I see 11,000 contracts betting on $20,000 gold, I do not think that is insanity. I think that is someone who understands the endgame. They are not betting on gold. They are betting against the dollar, against the debt, against the system's ability to manage what is coming without debasing the currency. And historically, that bet has never been wrong. Every fiat currency that has faced this level of debt relative to output has eventually been debased. Every single one. Same pattern, same sequence, same outcome. Look at what is happening with implied volatility. The $20,000 calls have lifted implied volatility for far upside strikes across the entire gold options chain. That means the market is pricing in the possibility of extreme moves. Not 5%, not 10%. The kind of moves where gold stops trading on fundamentals and starts trading on fear, on capital flight, on a loss of confidence in the system itself. Realized volatility remains elevated after January's crash from $5,600 to $4,400 and the sharp correction in October. The market has not calmed down. It is coiling, and the options market is screaming that. Now let me show you what is happening with silver. Because if the gold trade is a high probability bet, the silver setup is a powder keg. While everyone was fixated on the gold crash, something happened with silver that nobody in the mainstream financial media covered. And when you understand what I am about to explain, you will realize why silver might be the single most asymmetric trade in any market right now. In November 2025, the U.S. Geological Survey finalized its 2025 list of critical minerals. They added 10 new minerals to the list. And for the first time in the modern history of the United States, silver was included. Silver is now officially classified as a critical mineral essential to U.S. economic and national security. Alongside lithium, alongside cobalt, alongside uranium, alongside rare earth elements. This is not symbolic. This is structural. Critical mineral designation legally mandates government focus on securing domestic supply chains. It triggers enhanced permitting for mining projects, subsidies, tax incentives for domestic production, and most importantly, strategic stockpiling. The Defense Logistics Agency manages the National Defense Stockpile. Congress just appropriated $2 billion to expand it. The Department of Defense announced its intent to procure up to $1 billion in stockpile materials last year. And now silver is on the list. That means the U.S. government will stockpile silver. It is not a question of if. It is a question of how much and how fast. The policy infrastructure is already in place. The funding is already allocated. The legal framework is already established. All that remains is execution. And here is the part that should terrify anyone who is short silver. China controls 70% of global refined silver supply. 70%. And on January 1st, 2026, China officially added silver to its rare earth minerals export control protocols. They are squeezing supply deliberately. So you have the United States saying silver is a critical mineral and we need to stockpile it. And you have China saying silver is a strategic resource and we are restricting exports. Two superpowers. Same metal. Opposite sides of the trade. Both trying to secure as much physical silver as possible before the other one does. This is economic warfare. A strategic battle for control of a metal that is embedded in every major technology of the 21st century. Solar panels, electric vehicles, semiconductors, military radar systems, medical equipment, 5G infrastructure, water purification. Silver is in all of it, and both governments know it. You cannot build the future without silver, and the country that controls the supply controls the future. Let me show you what is happening on the ground, because the physical data is even more alarming than the policy announcements. Shanghai Futures Exchange silver inventory has dropped to 11 million ounces. 11 million. That is threadbare. There is barely any metal left in the warehouses. COMEX registered silver, the amount available for immediate delivery, just broke below 100 million ounces. These are the lowest levels in years. The physical market is tight, and it is getting tighter. Silver lease rates spiked above 6% recently. They have eased back to around 3%, but that is still not normal. A one-month lease rate of 3% tells you there is real tightness in the physical market. People are willing to pay a premium just to borrow the metal temporarily. That does not happen when supply is abundant. That happens when supply is stressed and users are desperate. And here is what really matters. In the weeks leading up to the January crash, something unprecedented happened across the entire silver industry. As silver ran from $30 to $121, the hedging costs for refiners, dealers, and wholesalers became unmanageable. Think about what happens when you are a silver refiner and you need to hedge your inventory. You go short on COMEX futures to offset your physical position. That is standard risk management. But when silver doubles and triples in a matter of weeks, the exchange keeps raising margin requirements. Your hedging costs explode. Your credit lines get maxed out. And suddenly you cannot operate. That is exactly what happened. Refiners locked up first. They stopped accepting metal from sellers. Then coin shops could not get supply from refiners, so they stopped buying and selling. Then wholesalers ran out of capital to post margin. The entire supply chain froze. Not because there was no demand, because the financial infrastructure could not handle the velocity of the price move. The industry broke temporarily at $121. Now think about what happens at $200, or $250, or $300. The same infrastructure that broke at $121 does not get stronger at higher prices. It gets more vulnerable. Because the lesson the industry learned is that when silver runs, the system cannot keep up. And that creates a feedback loop. As the infrastructure breaks, physical shortages intensify. As shortages intensify, prices spike harder. As prices spike, the infrastructure breaks further. It is a doom loop, and we are already inside it. Now let me address the crash, because I know many of you watched silver go from $121 to $64. That is a 47% wipeout in a matter of days. Some technical analysts declared it a final blow-off top. They said silver was finished for decades. I have seen the posts. I have read the analysis. And here's what I think. Silver went up 140% in 2025. Then it went up another 70% in January alone. 70% in 1 month. I do not care what asset it is. Gold, silver, Tesla, Nvidia, soybeans. If you show me a chart that went up 70% in 30 days, I am going to tell you a correction is inevitable. And a correction came. A violent one. But a correction is not the same thing as the end of a bull market. Here is what tells me the bull market is not over. The mining shares. Silver mining stocks only dropped about half as much as the metal itself during the crash. In a true blow-off top, the miners get obliterated. They lead to the downside. That did not happen this time. The miners held. And in previous bull markets, whether it was 2003 to 2006, or 2009 to 2011, or 2020 forward, the miners holding while the metal corrects has been one of the most reliable signals that the move is not over. We are in a transition phase, not an ending. And here is the fundamental picture. Silver is still in a global supply deficit. Fifth consecutive year. Demand is outpacing mine supply, and the demand is coming from both sides. Industrial demand from solar, EVs, semiconductors, defense systems, and investment demand from people and institutions who are watching the same macro data I just showed you and saying I need hard assets outside the banking system. That dual demand is what makes silver different from gold. Gold is primarily a monetary metal. When trust in the system declines, gold goes up. But silver gets pulled from both sides. Investment demand pulls metal out of the market. Industrial demand pulls metal out of the market. Supply cannot keep up with either. And now you are adding government stockpiling to the equation. Three sources of demand. One constrained supply. Not might squeeze. Will squeeze. The big banks know this. There are credible reports that JP Morgan has flipped net long on silver. They moved their metals trading desk to Singapore. They are financing the new critical minerals smelting facility that the Department of Defense commissioned. The commitment of traders' data shows the 5 large U.S. banks have collectively reduced their net short positions and in some reports flipped net long in futures contracts. Now the full picture is more nuanced. The commercials are still net short overall, and we cannot see the over-the-counter derivatives positions. But the direction of the change is unmistakable. The banks are shifting. The same institutions that suppressed silver for decades are now positioning for the upside. When the suppressors become accumulators, you pay attention. Not might happen. Will happen. There is a saying in this market that I think about constantly. 90% of the move happens in 10% of the time. If the precious metals bull market started in the year 2000 with gold at $252 per ounce, we are 26 years into the cycle. 10% of 26 years is roughly 2.6 years. Silver broke out about 6 months ago. That leaves approximately 2 years. And if history is any guide, that is when the acceleration happens. The exponential phase. The phase where silver does not go up 10% or 20%. It goes up multiples. It goes vertical. And the people holding physical metal during that phase experience wealth transfers that rewrite family trees. Here's the connection that ties it all together. The $20,000 gold bet and the silver stockpile. If gold moves to $15,000 or $20,000, as those 11,000 contracts are implying, silver does not stay at $77. Historically, the gold-to-silver ratio compresses late in precious metals bull markets. If gold triples and the ratio moves back toward 40 to 50, silver goes to $300, for $100 or higher. Yet today it's still down nearly 40% from its high, during a supply deficit, just as the U.S. prepares to stockpile and China restricts exports. After February 1st, 2026, large corporate 401(k)s are allowed to offer gold and silver. Not required, but allowed. In a market as small as silver, even a tiny allocation shift creates massive demand pressure. Wall Street is already positioning for a new model. 60% stocks, 20% bonds, 20% gold. When gold absorbs that flow, silver always follows, and its moves are always more violent. Geopolitics adds fuel. In a major crisis, gold goes limit up and silver follows, benefiting from both safe haven demand and rising industrial use. The January crash wasn't the end, it was a shakeout. Physical demand remains, supply deficits persist, and every dip finds buyers. This isn't the end of the repricing. It's the beginning.